Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, October 14th. Well, it's an understatement to say the week got off to a good start for investors. Rallies like the one seen Monday don't happen often and haven't happened ever in some cases. Yet, as any investor knows, these are extraordinary times. The rally looks set to continue too, as the futures for the major indices are well above fair value, indicating a sharply higher open to the tune of nearly 4% for the S&P as of this posting. If the latter indication were to hold, the S&P would be up about 24% from its low on Friday. It's a wee bit early to call this a new bull market, but the occurrences over the last two trading sessions have laid waste to the case for trying to time the market bottom. The positive disposition this morning is a carryover from yesterday and a response to an initiative put forth by the U.S. government to inject $250 billion in new capital directly in U.S. banks, 9 of which will receive $125 billion. Those 9 institutions are Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, Bank of America, Merrill Lynch, Citigroup, Wells Fargo, Bank of New York Mellon, and State Street. Additionally, the FDIC will guarantee most new bank debt for 3 years and ensure non-interest-bearing accounts. The core elements of this latest plan were anticipated by the market yesterday. Even so, it is a clear reminder that governments the world over are taking drastic and necessary measures to arrest the financial crisis and to get credit flowing again. Anecdotally, there have been some positive developments on the latter front. LIBOR rates, from overnight to 12 months, have decreased from their prior fixings in the wake of the coordinated government action. This improvement in the credit market is essential for restoring investor confidence, certainly in the near term, as it will be viewed as a gauge of the effectiveness of government efforts. A positive start lies ahead for the stock market, as last week's selling panic has been supplanted for the time being with a buying panic, with participants fearing they are missing out on the big rally. As noted yesterday, we expect the rally effort to find resistance at some point, as many anxious investors use it as an opportunity to calm their nerves by selling at higher prices that have lessened this year's sizable losses. The tone of the market is certainly better for now, although it is evident in a growing number of earnings warnings that the frozen credit market has had a deleterious effect on the economy. Worries about the extent of that impact will continue to hang over the market. Separately, Johnson & Johnson and PepsiCo both reported results today. The former company beat estimates and issued full-year guidance above estimates, while the latter company missed estimates and issued full-year guidance below estimates, citing the adverse effects of a stronger dollar. Intel reports tonight. The currency impact is another issue for another day, but it is something we have expressed reservations about with respect to the outlook for earnings and economic growth. It should not be dismissed. I'm Pat O'Hare for Briefing.com. Thanks for listening.